Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So major tech indices have printed a bearish engulfing candle here after a huge period of euphoria where we actually saw indicators like the put-call ratio spike to extreme lows, the put-call ratio being a great gauge for complacency or fear in the market, marking bottoms when it spikes to the upside and marking tops when it spikes to the downside. We also have a major superpower, the Chinese economy, that's actually showing clear evidence of contraction. We recently got a data point on Chinese exports year over year that shows a 7.5% contraction this year. This was a huge miss relative to the estimates. So I'm going to show you exactly what the implications of these developments are, give you both the bearish and the bullish arguments behind these developments so that you can make your mind up. And of course, I will give you my humble opinion on all of this. I hope you guys enjoy this video. If you do, don't forget to smash the like button and of course subscribe to the channel if you are new here. Now without further ado, let's get right into it. So let's start with the put-call ratio that spiked here at the beginning of June 2023, which, by the way, June being one of the worst months of the year from a seasonality standpoint, you can generally expect volatility to materialize throughout the month of June from a historical perspective. And you did see this extreme reading here on the put call ratio, meaning a lot more calls in the market than the number of puts, as you had the stock market actually go on a type of melt up here. So this is what happens when a lot of investors get scared. When a lot of investors get scared that they are underweight in equities, that they see the markets breaking out, melting up, they buy a bunch of calls or they get squeezed out of their puts on the market as they essentially get stopped out. So it can be a sign of complacency as the market is rising and also a sign of capitulation. All of the bears getting squeezed out of the market on this move. The last time we were this low was in February of 2023, which was a top in the market. And before that, it was actually in November of 2022, which wasn't the top, but it was pretty darn close to being the top in the market. You can see also the August high in 2022 was also marked by a very low put-call ratio. Same thing with the March 2022 high here that was marked by a very low put-call ratio. But beware, because you can have spikes like we had here in July, as we did see a pretty powerful type of short squeeze in the market here in July of 2022, which marked a brief correction, but the market ended up moving a lot higher very quickly. So this is about putting the odds in your favor. It's more likely that you're nearing a significant top if the put-call ratio reached an extreme level. It's more likely that you're nearing a significant top if the put-call ratio reached an extreme low, but it doesn't guarantee it. And you can see, of course, this is easy to spot the tops during a bear market, but during bull runs, you can see the put-call ratio can actually remain very low for extended periods of time, and it produces a lot of false sell signals. So if you're of the opinion that we are on the brink of a massive economic recovery, as we see inflation come down, the Fed stop its hiking cycle, and stocks begin a melt up here, then this is really not a signal that you should be paying attention to. Now, we also got a pretty interesting development here on the NASDAQ 100, a bearish engulfing candle after a pretty impressive melt up move as we had the AI euphoria prop up big tech companies. Now, a bearish engulfing candle is exactly what it looks like. It's when you have a big red candle that engulfs the previous candle or the previous candles. It can oftentimes big reversals in the market. If you do a quick Google search on it, this is the type of chart that you'll be able to find. From a textbook technical analysis, this is a bearish reversal pattern. A great example of that was actually here at the very top, the all-time high in November of 2021. These tech stocks printed a bearish engulfing candle, a pretty obvious one here. The market never took out that high. So textbook bearish engulfing, you can spot one here in January of 2022, big bearish engulfing candle here, but they don't always work. You can see here in November of 2020, big bearish engulfing candle, engulfing the two previous candlesticks here. That was almost immediately reversed and was followed by quite a significant run, to say the least, on the NASDAQ 100. Now, this is my favorite chart on tech. This is why at Game of Trades we are bearish on the technology sector. We even have an active short position on this sector that you can find out more about if you go to our website. But this shows the relative valuation of technology stocks against the S&P 500, so against the rest of the market since January of 2019, and you can see tech is more expensive than it has ever been, even more so than during the pandemic, where you could argue that tech was unbelievably attractive because of the nature of the pandemic and how beneficial it was to technology in general. And you can see the elevated PE ratios of technology stocks in the pandemic was actually justified because eventually earnings, this black line here, the actual earnings, the revenue of these companies followed through, and you actually did see a surge in revenue in the 2 years that followed the surge in tech stocks in 2020. Here we have a very different setup where these valuations are a lot more expensive than they were in 2020, but you also have generally deteriorating fundamentals, revenues going down, not going up for these big tech companies, which is generally not such an attractive setup. Now, of course, that is rational thinking, and the market is not always rational. If you believe that we are entering a phase of bubble type of behavior, then clearly this move has room to run. In 1999, the relative PE ratio of technology stocks against that of the S&P 500 reached almost 2.2 times more expensive. Right now, we're only at around 1.4 times more expensive. So if we are entering a period of irrational market behavior, who knows how far this could go. Again, giving you my humble opinion, while the tech run could last a longer, bubbles tend to burst when you hit recessions. Whether you look at the NASDAQ 100 bubble, or you even go back to the roaring 20s, the credit bubble that developed, that stock market bubble popped when the recession began. So bubbles are popped when recessions hit, and while we're probably not heading into a Great Depression right now, we are very likely heading into a recession. So from a time perspective, I do think this rally is closing in on us very rapidly. If that wasn't the case, if we were in an environment where we didn't see an imminent recession, then we would likely be participating in this trade, because again, from a valuation standpoint, you can definitely make the case there is more room to run on this AI narrative. By the way, don't forget to smash the like button if you're so far enjoying this video, you like the data that we're providing in these videos, you're learning something new. It really helps the channel out. Now, coming to the point of Chinese exports that came in at 7.5%. That is a concerning signal for the global economy. Chinese export is essentially a great gauge for consumer strength in the US and in Europe, because China is where we get our stuff from. So if Chinese exports are down, it's definitely not a great sign for the global economy. In fact, you can look at Chinese government bond yields, the 10-year yield in China, and that's been coming down quite aggressively. If we put this chart of Chinese bond yields against the US PMI, so this orange line basically showing us economic manufacturing activity in the US, they show a very, very strong correlation, and China often leading the manufacturing cycle in the US, right? You can see here Chinese bond yields in December 2017, aggressive move down here before an aggressive move down in the manufacturing cycle. In the US, we actually saw the same thing here, where this big move down in China, big weakness in China throughout this period told you that this strength that we had in the US back in December 2021, you could have used that as a leading indicator that the manufacturing cycle was going to turn around and that the US economy was going to slow down. And so while there are a lot of people that are currently calling for a bottom in PMIs and a surge in economic activity right now, and who knows if that could possibly happen, but that's not what China is telling us right now. China is saying that the global economy is continuing to slow down, that we haven't entered a strong phase of recovery yet, like we did, for example, in 2016, like we did here in February of 2009, where Chinese bond yields began to price in a recovery in the global economy. Now, of course, the counter argument to this is that the Chinese government is very soon going to begin stimulating the economy, injecting credit, injecting stimulus, and that's going to lead to a surge imminently but of course we haven't seen that happen yet. So until that's the case, this is the chart that's in front of us. If we look at an index like COPEX, Copper Miners, which follows the price of copper, that also gives us a great indication of the Chinese economy. And back in November of 2022, we were actually very optimistic on the Chinese economy as it was reopening, was lifting COVID restrictions. You had some signs that the Chinese authorities were beginning to inject credit in the economy that could create potentially a reopening boom. And so we used COPEX for a quick 10% profit on the Chinese reopening and a weakening dollar. We're very transparent about the track record of the ideas that we include in our model portfolio. That's really designed to give you access to high quality ideas with very attractive risk rewards. We have an incredibly competent team in terms of research capabilities, and the price of the membership is incredibly cheap for the quality of the research that we provide. This is just not the type of product and service that you're going to find anywhere else. In fact, we will be increasing our prices quite substantially for all new members starting next month. So if you want to lock in the price at current levels, make sure to start your free trial. Now that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and of course subscribe to the channel if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.